Hey everyone, Scott Wirtanen with Honest Rate, and thank you for checking out our video on sellers concessions. So today I want to break down a few things, which is number one, what are sellers concessions? Number two, how do they work? Number three, what are some of the ways that you can use it? And then number four, why is it important to have your realtor and your lender on the same page when it comes to structure and how to negotiate a deal? So first and foremost, what is seller's concessions? What does it mean? Essentially what it is the amount that the seller of your property, of the property that you're buying, is willing to pay for closing costs, right? So if you're buying a home, especially if you're a first-time home buyer, so let's break down a few things. Whether you're a first-time home buyer, you've done this before, but there's generally a few things that you need to be aware of as far as out-of-pocket money. And this is where working with a lender, getting pre-approved is important. So you have the down payment of the house, you have closing cost, and then you have taxes and insurance. And then on top of that, if you have any sort of inspections, that would be like out-of-pocket expenses, inspections, appraisals, things of that nature. So when you're negotiating up front to buy a home, you can go in and, let's say a house is listed for $300,000. Obviously you could offer them $300,000 and just make it a very basic, straightforward offer. Some people are coming in and saying, hey, I don't want to pay $300,000, I'll give you $275,000. Or you can also negotiate what is the price of the house and how much of that price is the seller going to give back to you as the buyer to cover closing costs, taxes, or insurance. And why is that beneficial? So you could go in this scenario and you could say, hey, I'll give you the $300,000 you're asking for, but I want you to cover $10,000 towards closing costs, taxes, and insurance. So that's essentially what seller's concessions means. Let's dive into how does it work and what are some of the things you need to know. So first of all, the general rule of thumb, and this can, there's always caveats and what ifs, but the general rule of thumb is that seller's concessions can cover the actual closing costs of a loan, which you can get from a loan estimate on talking with a lender or a broker on the mortgage side. If there's money that's due up front for property taxes or homeowners insurance, and if there's prepaid interest on the new loan. So generally, that's what it can go towards. Now, as always, I'm sure lenders out there that will have carve-outs and do things differently, but usually it's not going to be used for the down payment. So you as the buyer, you're coming up with your down payment, and then who's covering the closing costs is where seller's concessions comes into play. There's also generally guidelines on mortgages as far as what percentage of the purchase price is allowed to be used as seller's concessions. So one of the common ones most people know about is if you're looking at a quote-unquote FHA loan, you can potentially get up to 6% of the purchase price as concessions from the seller. So in this scenario, if the house is worth $300,000 and that is the agreed upon purchase price, the seller can give up to $18,000 towards closing cost in the seller's concessions. It's important that you talk with your lender about your pre-approval and what type of loan you're approved for to figure out what are those limits. You don't want to be in a scenario where you're asking for too much or too little, so that's why it's important to understand that part up front. The second thing to talk about is, does it make sense to get seller's concessions? And what I would tell you from my personal perspective is really driven based off of you personally. What are your goals? What are you hoping to accomplish? And talking with the mortgage company or talking with me is we would try to figure that out. And I think there's some general math, and I don't want to overcomplicate this, but I think there's some important things to think through when you're debating, do I negotiate a lower purchase price? Do I negotiate seller's concessions? Do I need it? Do I not? And how do you best do that? And here's the general rule of thumb, in my opinion. So if you're looking to reduce your total money out of pocket at closing, seller's concessions really helps more than reducing the price of the house. And what I mean by that is, in this scenario, using the $300,000, and let's say again you ask for $10,000 from the seller, and now you're saying, okay, so I can either get that as a concession towards my closing cost, or I can reduce the purchase price to $290,000. So if you think about your down payment, right? If you're putting 20% down and you reduce the purchase price by $10,000, you save $2,000 out of pocket. If you get it as a seller's concession and your closing cost and taxes and insurance are at least the $10,000, then you're saving $10,000 out of pocket because they're applying that upfront. So generally speaking, the lower your down payment, the more impactful seller's concessions can be, because in a scenario where maybe you're a first-time home buyer and you're qualifying for 3.5% down, well, 3.5% down of the $10,000 difference, you're much better getting the $10,000 up front versus only using 3.5% of it, which is the down payment difference. The second piece in this breakdown for the seller's concessions is, what can you use it for? Well, in a lot of cases, you can actually use it to buy a lower interest rate, right? So within your closing cost, and I'll have a whole other video based on a closing cost breakdown to help you all through that. But when you're looking at a lender's estimate, whether or not you're on their website, or you're looking at an official loan estimate, or your closing disclosure, or what back in the day used to be called a HUD-1 statement, you'll see all the different line items for what fees are built into the loan. Or in this case, a purchase is required to be paid up front. But you'll see the fee breakdown. And one of those is something that's called discount points, which in a lot of scenarios is optional. In some scenarios, based on qualifying factors, you may not have options. But let's assume you have options. Let's assume you have interest rates that do not require you to pay discount points. And then let's assume you can get lower interest rates if you pay discount points up front. And discount points, as a brief breakdown, is essentially just prepaying interest one time to get a lower interest rate long term. So again, going back to what I said in the beginning, your goals, really important. Your thoughts on how long you're going to be in the house, your goals for your cash flow, what do you like, all of those things come into play to figure this out. But as a general just sort of learning point is, I was looking at a loan earlier today and have a borrower who's looking in the 400,000 range. But it's the same logic, whether it's 100,000 or $1 million, the logic is the same, which is, okay, in this scenario, they can get one interest rate and not pay those points. So if they went in and made an offer on this house and didn't ask for any concessions from the seller, and didn't want to pay any points and just paid the basic closing costs, the borrower gets one interest rate. Or they could go in and say, you know what, I want the seller to give me this credit, this seller concession, so I can get myself an even lower interest rate. And the difference when you look at it, when we ran the math to say, what if the purchase price was $10,000 lower versus a $10,000 higher purchase price, but using the concession to lower the interest rate, and which one is better? And in this scenario, the payment difference between the higher rate with the lower purchase price or the lower rate with the higher purchase price, the lower rate was actually about $120 per month less, even though the price of the house was about $10,000 more expensive. So in this scenario, my borrower decided that was more of what they wanted. That made sense for their budget and where they were financially. And in looking at what they thought projected for interest rates, not convinced that there's going to be some major crazy drop in interest rates, that if they keep this loan for 3, 4, 5 years, the difference in payment, the difference in how much goes towards interest versus principal, in their opinion, it was a better loan, and it got them into a position where they were happier. So it's really critical to be able to understand, what are your goals, what are you trying to do, and what are those options. So that brings me to my last point, which is, what I've said in videos before, but pre-approval up front is really important for a few reasons. Number one, most realtors are going to want you to be pre-approved before they spend a whole bunch of time with you. But number two, beyond that, if you're sitting there watching this video going, Scott, I know I'm approved, like my income is solid, I have no debt, like I'm a slam dunk. Okay, cool. Approval is part of it, but game planning, how you want to set up the loan to match your goals and your offer is really important. So talking with somebody and saying, okay, what are my options? Should I do seller's concessions? Should I not do seller's concessions? What are the pros and the cons? And it can change from market to market. There are some times where spending a little bit upfront in closing costs for that seller's concessions can give a massive improvement in interest rate, and sometimes not. So understanding with your lender, hopefully us at Honest Rate, what are your options and what makes sense is critical up front, because then when you're talking to your realtor, and if you want us to, we'll talk to your realtor and just explain the basic details. We'll never explain anything to do with personal information, like where your privacy is always critical to us, but it is totally okay for us to have a call with your realtor, meet with your realtor, do a Zoom, do a conference call, whatever you prefer, and just say, hey, we decided together that based off of the goals that we believe that asking for discounts in the seller's concessions is much better than asking for discounts off of the purchase price. So let's make sure we prep for that before you make the offer. It's much easier to make the offer up front versus having to get the offer accepted, go back, and renegotiate later. So having sort of that teamwork between your realtor and your mortgage person is critical. So in summation, to kind of just put a bow on this and wrap this up, is that you have some creative ways that you can work with your lenders if they're experienced and are willing to go over multiple different options, that not every negotiation and not every deal is the same. It should be custom tailored to you and your goals, and maybe even to take it a step further, to each individual property. I like to talk to my borrowers about the general pre-approval, the general concept, but then also we say, hey, before you put in an official offer, call me, give me the rundown. Let's talk to your realtor. Let's say, hey, if you offer on this house, here's how we should set it up. Let's look at the property taxes. Let's get an estimate of insurance. Let's try to figure that out up front. So having that partnership, having the understanding up front, and understanding what is good for your goals is really critical. So hopefully this helps. Hopefully you learned a little bit about seller's concessions or seller paid closing costs. And as always, if there's anything we can do to help you, please visit us at honestrate.com. Send me a DM. Call us personally. Whatever we can do to help you, we're happy to be a resource, and I appreciate you watching. Happy New Year, and we'll talk soon.